We are living through pretty extraordinary economic times, and I don't think the volatility, typically when you look at the historical volatility, when it starts whiplashing like this, it gets more and more severe. So the big question is, are you ready for that? Are you prepared for that?
I mean, it's out there crazy right now, the amount of people that just are putting content out, pretending like they can forecast and talking so much about the news and the tariffs and this and that. I mean, it's like, tune out the noise, work your plan.
So not panicking and pulling out, it's crazy what just riding it out so you stay in there for the good days and keep pumping the money in really does make just an astonishing difference.
Let's get guaranteed things and do guaranteed things, and let's let growth things do what growth things do, and then follow that process. You can really do well long term, but you got to be disciplined.
All right, hey everyone, what's up? Welcome back to Remnant Finance. We got Scott Osborne with us here again. We're going to be talking, this is our third interview, and it's actually going to be a nice follow-up to the last one where we discussed volatility. And Scott made the point that we need to be prepared for market volatility, and we need to have our asset strategy in place to be able to withstand deviations to the norm. And so, funny enough, a couple weeks later, we're experiencing some of the sharpest kind of whiplash effects that we've had in a long time, since I think maybe the 2020 COVID drop in March, where we just had this plunge and then straight back up. We had the same thing last week over the tariffs. I believe the shortest time span drop and then a immediate recovery within a few days later. And this is all based on some tweets essentially. And this is all from news of, you could call it credible threats, however you want to frame the tariff discussion. We can get into some of that today, but we are living through pretty extraordinary economic times. And I don't think the volatility, typically when you look at the historical volatility, when it starts whiplashing like this, it gets more and more severe. So the big question is, are you ready for that? Are you prepared for that? And then let's talk about how do we make sure that we can sustain right now and also use this time opportunistically to set ourselves up for the future. So that ties in, again, the things that Brian and I do with what Scott does. Brian and I's strategy in a time like this, what we help you put into place is going to help you weather the next, say, 12 months of volatility if you're not getting this growth. And what Scott does is going to help you, once this down period is over, to be optimally positioned for future growth. So, Scott, what do you got?
Yeah, thanks, guys. I appreciate the opportunity, and I always feel bad, like it was my fault. We published an episode on being prepared for volatility, and it was like we kicked it off. So apologies to everybody. But no, in all seriousness here, I mean, I think it's important in these times to really revisit your plan and make sure that your decisions that are being made right now are rooted in the foundations of your financial plan and the goals that you're trying to accomplish, not emotions. And candidly, even there's two things to really look at. If we look at the emotional side, yeah, it can be, nobody wants to see our accounts go down, especially as rapidly as they went down over the past, couple of weeks. It can be easy to feel a little victimized when you see the market swaying so far up and down based off of what's, getting reported out of the White House. So, that can be very frustrating, and it feels like just a completely untradeable market. And it feels like untenable, for most investors. And that drives people to either make bad decisions like going to cash in the middle of some sort of crash, or keeping their cash on the sidelines when they should be investing for the long term. So to me, I think, there's that emotional side, but then there's also the data side, right? And the data side would tell us that regardless of what volatility is going on right now, it's somewhat irrelevant in terms of what our long-term plan is. But I think it's a good reminder of a lot of my clients have heard me say for probably a decade at this point, like the news is unpredictable. The stock market responds to news. Therefore, the markets are unpredictable. And so if the markets are unpredictable, what are you going to do? We can try to time a top. We can try to time a bottom. The data would say, you're not good at it. Nobody's good at it. Don't try to do it. The other thing you can do is, stay on the sidelines and miss out on the long-term returns that the market has for us. I would also advise against that, but at the same token, if you're going to be an equity investor, I mean, even Warren Buffett had said hey, you look back at the last century of investing, and we've had 3 times where the market's been cut in half, 3 times. So the odds are it's probably going to happen at least once in your lifetime. If you're not willing to see your equity accounts get cut in half and stick with it, stock market investing might not be for you. So you got to really, have a good plan, know that they're going to go up and go down, and know that sometimes they're going to go down by a lot. And you got to be willing to handle that. Now, I could tell you the people that are able to handle that the best, in my opinion, are those that have a good long-term plan. I know before we hit record here, I was telling you guys last week was one of the busiest weeks of my career, and it was not talking people off of the ledge. It was figuring out what are we going to go buy. So if we look back here on the Thursday and Friday before last, those are two of the worst trading days that the stock market's had on record. Now, we're not privy to any inside information, but Monday and Tuesday were a really, really good time to be plowing cash in. And that's not to say like, oh, we knew the market was going to go back up. We didn't know what the president was going to say, but we did know that the market, when it goes down that rapidly and that significantly, tends to be a good time to buy. And again, even right now, as we sit here, we don't know if the market's going to continue to go down further or if it's hit some bottom and is coming back. I mean, nobody knows, but the data would tell us that if the market tends to go into some sort of, correction at a 10% loss, or what we call a bear market when it hits a 20% off of its high, as it settles into its bottom and comes back. I mean, if we look back from 1949, the 12 months following those really turbulent times have always been double-digit positive, always. Will that continue? I don't know, but it's a 70-year trend of that kind of data set. So to me, it's helpful to just look at historically, knowing that, what's going to happen in the future isn't necessarily exactly what's going to happen in the past, but, we can pull some segments of truth out of there and know that, hey, after the market's had a big downward trend, the market tends to overreact to the news, can be a great time to buy. So we want to have some sort of availability to cash. And I think that's where you guys come in.
Yeah, it is. But before I wanted to point out that I'm not quite sure what was different, but there was no panic of a recession with that massive drop in 2020 versus a week ago. That I just can't put my thumb on what's different in those times. But I actually pulled up this just to back that up before we talk about our stuff. I just pulled up something with HartfordFunds.com that just gave some pretty interesting data on like historical patterns of bull and bear markets. And it says that avoiding the market's downs may mean missing out on the ups as well. 78% of the stock market's best days have occurred during a bear market or during the first 2 months of a bull market. If you missed the market's 10 best days over the past 30 years, your returns would have been cut in half. And missing the best 30 days over those 30 years would have reduced your returns by 83%. And so it shows the growth of $10,000 from 95 to 2024. That 10,000 fully invested all days is 224 grand. If you miss the 10 best days, you're down to 102,000. The 20 best days, you're down to 60,000. If you missed the 30 best days, you only have $38,000. So not panicking and pulling out. It's crazy what just riding it out so you stay in there for the good days and keep pumping the money in really does make just an astonishing difference.
Yeah, I mean, we don't want to stop the compounding machine here. I can tell you, like, end of last year, I'd probably take a little bit of a balanced approach where, we don't put everything into like one, maybe hyper aggressive investment and just let it sit there forever. So we do some pretty active rebalancing, and that's in our checklist here. And we like rebalancing when things are high and rebalancing when things are low, can make a lot of sense, right? So like if you look back at last year, we're coming off of 2 back-to-back well above average years in the market. That might be some time to sell some of our, large company stock like the S&P 500 and buy some more of those conservative investments and skim some of those profits, right? That's a lot different when you're like, hey, I have a process and I'm following my process, than it is to say, I got a tingle in my spine. I'm going to take my whole account to cash and sit on the sideline for an unforeseen amount of time and then wait for the crash. I was talking about this with a client this morning, actually at coffee, and we were just discussing investing in real estate. I know you guys are both real estate investors and he is too. And, we were discussing how, you look back at this real estate bubble that's just gone nothing but up in value from 2008 to 2020. And then post pandemic, just a huge inflation of housing pricing. And, you heard people back in 16 and 17 wanting to buy real estate saying, hey, there's a bubble here that's getting ready to pop. I'm going to sit in cash and not buy anything and wait. And even if there was a huge housing crisis in 2020, like four, let's say, right? There wasn't, but let's say there was, and they bought it after it quote unquote crashed. You could feel good about that, but you're ignoring the reality that you've missed out on all these previous returns. So maybe you didn't see your account go up and down while you were sitting in cash, but the reality is you missed out on all these compounded returns. And then in your mind, you feel good because you bought low. But if you run the numbers most times, you're going to realize that you're on the wrong end of that, because most of these markets, real estate, large cap equities, et cetera, they're positive 8 out of every 10 years. So 80% of the time it's positive, and you're going to try to time that 120%. I mean, you're missing out on all that compounding throughout your investing career. So generally speaking, it might emotionally feel good that you bought some dip, but realistically, you're not enabling that compound interest to work on your behalf.
Yeah. Now let's say that you do stay in the market, like you're saying, and you see the dip, and you alluded to this question, but I went off on the side reading that webpage. What could we do because of the position that Hans and I put in? Hans, like, how much access do you have if you want? And we're just talking about the market here, but this could be anything. This could be housing. This could be if you see gold drop 30%. If anything you're invested in, whatever you're interested in, what can we do, Hans, because of the way we position our clients?
Yeah, we're just ready. We're ready with the dry powder. We're ready with available access to capital, especially in a time where banks are really tightening up lending restrictions. I mean, going back to 2020, I remember my wife and I were on a trip in Vermont because we had to cancel our Ireland trip. The market took that huge plunge, and I'm on the phone with USAA for like 2 hours while we're on this vacation, trying to get a personal loan. I was like, as much as you'll approve me for at any rate you want, just give me. So I ended up getting like $40,000 at 21% or something like that. Something absurd, something that would, that would be a terrible thing to do in most circumstances. But I was like, I don't care the rate, whatever you'll approve me for as quickly as possible. Like if I need to wait like a week to get higher than that, whatever the cap is, you can approve me for today. And I put that whole thing into the market and paid it off within about 10 days, paid off the loan and just let the rest ride. So having that dry powder available, had I been doing IBC at the time, I wouldn't need to be negotiating. I wouldn't need to worry about what the rate is, how much you'll approve me for, because I knew I would have contractual guaranteed access to know exactly how much I could get. And within a couple of days, I could have that ready to go. I was actually thinking on Sunday night last week, when it was clear that, the crypto market, which is 24/7, was plummeting. The futures index was plummeting, and everyone was expecting like Black Monday is going to open up and be this huge drop. And I was like, I have available cash value, and maybe 48 hours is about what I could expect to get in my account should I request a policy loan right now. I didn't, because I'm trying to get, just focus on the strategy that I'm doing and not just try to emotionally jump in. Like, I have a plan, I'm going to stick with that. But I did think about it, but it was nice to know that if I wanted this within about 48 hours or so, I could have that money guaranteed dropped into my account with no questions asked and no underwriting. It's a powerful place to be able to be ready to pull the trigger on stuff like that.
Yeah, I mean, and first of all, that sounds like the kind of loan that you can get like outside any military base as well. Right down the street, that kind of loan's always available for any new Joe, that's for sure.
They were trying to talk me out of it because they were expecting like, don't go and buy a Corvette with this, like your typical, But I was like, listen, I get it. I'm literate here. I know what I'm doing. Just approve it, whatever.
Like, I'm buying an engagement ring for this girl named Crystal. It's going to go well.
Yeah.
So yeah, I mean, it's interesting, right? I mean, again, back to, trying to time tops and bottoms. I mean, I think, realistically, if you just zoom out far enough, this thing is going up and to the right, and nobody knows where it's going short term. But, it's not hard if you're some sort of news pundit to come out there and just say something like the market's going to crash, and say it once a month. And then when it eventually crashes, I can take credit for how smart I am. That's people out there. I mean, and you guys can see it. I mean, it's out there crazy right now. The amount of people that just are putting content out, pretending like they can forecast and talking so much about the news and the tariffs and this and that. I mean, it's like, when were tariffs getting discussed 3 months ago and free trade getting discussed 3 months ago? Nobody was talking about this stuff. Nobody. And so they're all responding to what's coming out of the White House. And that's where, for as much as possible, I try to encourage people, tune out the noise, work your plan. And like, I mean, I could tell from looking at client accounts, the people that just quietly go about their business and don't worry about what's going on with this stuff, perform better long term. And it's because they're not trying to do all these knee-jerk reactions of, trying to time a bottom and then feeling bad that they missed out on a bottom. And then, the day after the market went up by, what was it, almost 10% in a day. I mean, it turned right back over and had a little sell off the next day, by about 4%. So it's very, very volatile right now, but it's higher volatility than normal, but it's always pretty volatile. I mean, we look back at July of last year, we had a sell off of about 9% in a week. It wasn't all this news headline stuff and it wasn't in a day or two, but it's volatile. And if you can't handle the volatility, investing in stocks might not be for you. But if you can trust the data and have a good plan and follow it and a good process, you can really do well long term, but you got to be disciplined.
And even after the two consecutive huge drop days and people are losing their minds, you're still up on the year at that point. Like in your 12-month, like if you go back to where you were 12 months prior,
yeah,
you were up from that point. And so, yeah, you lost a lot. And there's a really funny meme of, on the first one, it was like S&P 500 at 5,000. And it was Leo DiCaprio in Great Gatsby, I think, just like this dinner party, champagne, everyone's like, we're millionaires. And then the next one was Leo in, what was that movie where he's like out alone in the woods and the kills the bear, it's just him the whole movie. It's a picture of him like looking up at the sky with this, bear slumped over him, like, why have you forsaken me? And it also says S&P at 5,000, like 12 years ago, you're toasting because the S&P just broke 5,000. 12 months later, it's still at that same point, and now it's like despair. And Brian hinted at it earlier, and we don't shy away from saying it here. What Brian was implying, the difference between the COVID crash and this crash, is the media hype. Like in that time, they intentionally shuttered the economy over cold and flu season, and the media was like, "Oh, of course we got to do our part. We have to shred the underpinnings of our economy so that we can make old people feel comfortable." And now the same old people are saying, how dare you impact my 401k? Like we were fine with shutting down the economy and just cratering the future prospect of the youth over the flu season 5 years later, because the media says this is Trump, this is Trump doing it, and therefore we're going to melt down because the media is saying that this is unnecessary. It's like, no, we could talk about tariffs and the macroeconomic things at play here. I am in the camp that restoring like our last shot at trying to save world reserve currency status and keep in our king of the hill position right now is going to require a massive disruption. And I think this is the massive disruption, and it's going to be pretty rough, but I think this is necessary. What wasn't necessary was shutting everything down in 2020, certainly. And so like to hear the same people that were like, oh, you got to keep me safe, young people, yeah, you can't get a job, your entire life is just shut down over nothing, now complaining about their market going back to where it was 12 months ago. Like you're fine.
One of the things that I think is interesting is like, this tariff thing is one topic. Like, first off, prior to me doing this, I was, a corporate executive. And, when you sit in certain rooms and get to listen to, like a CEO of a Fortune 150 company talk about the strategy of the company. I mean, I remember sitting in there listening to them talk about, we're exiting China, because of the unfair trade, because of the constant theft of intellectual property. And, there's a lot that goes on behind the scenes that's really driving, I think, some of this, return to American economic greatness. So I think it'll be great long term, but there is some short term pain that, we got to go through to go through this. So, but, realistically, how does it pertain to our money and our investments? I think, yes, it probably matters and impacts the short term. But if we zoom out, again, I will say this till the day I die, I don't think it really matters, because there are teams of people constantly trying to figure out, based off of what policy is getting developed in Washington, what policy different countries are developing outside of the US, that are always trying to figure out how to make more money and return value to the shareholder. I mean, that is what so many of these companies are doing. And so, when I look across that, Hans, I mean, you're looking at many, many other people just like us. They just happen to work in corporate America. I mean, they're talented, they're smart. They are trying to figure out how to do the best they can for the company that they're running. And so I believe in those people. I know they're just tickers inside of our portfolio, but I believe in the people running those companies for the most part. But by and large, these companies got a great track record of figuring out how to be profitable, how to return shareholder value. And so regardless of what's going on short term, I do think these companies are some of the best place to invest our capital and grow it long term. But you mentioned the ability of being able to put cash to work here at a short tip of a hat. One thing that I can think back to certain folks that I had met over the years, when I look back at like 2020, right? Market, S&P 500 market went down 33% in 30 days, fastest 1 month drop in the history of the market. None of my folks, but there were people at the time, remember rates were still super low. Interest rates were crazy low back then. There were people taking out home equity loans on their house to get access to capital to throw it in the market. And this is one of the reasons I really like this infinite banking concept, because it gets us some dry powder that's not sitting there doing nothing. It's sitting there, it's growing, it's compounding on our behalf, and it's providing an insurance benefit. But it's providing that capital, that dry powder that's on our balance sheet. It's not on the bank balance sheet. So you look at somebody who maybe took out $100,000 to throw it in the market when the market's down 33%. Maybe they, bought some individual stocks and took a little bit additional risk and maybe did really well with that. Well, that $100,000 loan requires one of two things, right? Either one, they got to pay it all back. And so I got to sell these investments that I bought to pay the loan back. And then I got to incur capital gains on the sales of those loans, probably short-term capital gains, which gets taxed at ordinary income tax. And so, yeah, maybe I made 60 grand, but is that moving the needle in my long-term financial life? I don't know. Maybe not for your situation. But more than anything, if I decide I'm going to hold on to these stocks, that means I got to hold on to this home equity loan as an example. Well, and then what did we see in 2022? Very quickly, that went from pretty much a zero interest loan to a 9.75 APR. And people that were, paying $200 a month on this thing, all of a sudden we're paying $2,200 a month on this thing. And that created a lot of pinch for people. And now I'm paying $1,800 a month to the bank, and my total return on capital, which ultimately that's what matters. How much money not do we make, but how much do we keep? How much do we grow our balance sheet over time, is starting to shrink every single month. And then you're doing that in the midst of your stocks tumbling by 27%. The S&P got down that low in the middle of 22. And maybe somebody's selling stocks then to pay some of that home equity off. And then these decisions start to compound negatively against you. So again, if we can keep the interest, if we can keep the capital, and we can keep all the growth all on our side of the balance sheet, we're compounding all of that on our behalf. So, I mean, that's what I really like about, again, dovetailing these strategies together, not really just working them one at a time, but like building this whole system around you to get these assets working for you.
Yeah, and if you think about the difference between me calling USA asking for a personal loan, someone going to a bank and trying to apply for a HELOC, and then you find that situation where your monthly payment 10x's, you don't have a say in that, and what happens if you don't pay that back? You can lose your house,
Oh yeah.
And so having a compounding, guaranteed, tax deferred growth doing its thing in the meantime, and then being able to access that without depreciating that capital, without underwriting, guaranteed, where you control the terms of the note. I mean, it is the ultimate flex in a situation like right now. This is a perfect case study for the value of having your savings in a cash value policy because of all of these contractual rights that you get. One thing to think about, we need to, like, I'm pretty into sports betting, and like if you're a bookie, theoretically, if I were a bookie, I want to balance, like, I don't really care how a team does as long as I get the action balance on both sides. To me, that's kind of the same as like trading sideways in the market. Professionals and banks will make money, and they could make money in a 10-year sideways market just on the volatility.
Yeah.
A lot of us depend on that upward eventual growth, but are we positioned so that we're capturing short-term volatility? Do we have, a kind of an option strategy in place to capture value on the downside as the overall trend of our portfolio grows? In the meantime, can you continue if you have, say, a 10-year sideways market? Banks are going to keep making money during that time. If a team goes 50-50, the bookie's still going to make money, because we're just talking about the value of understanding the value of how to capture money no matter what the market's doing. And so you quoted a number when we were talking earlier about, you can cite the statistic, but after drops like this, historically within 12 months, market's on a tear. And so when we want people to be set up with you to be able to capture that 12-month tear or in 12 months from now. But what about in the meantime? Is your drawdown strategy requiring you to take, distributions right now? Do you have to take distributions from your nest egg with the market after a 10, 15, 20% hit? And so Brian did a calculation that he can run through or just explain it, but the value of being able to take a couple years of your expenses from cash value, plucking out a few negative years in the market. Scott, you can fill in some of the details you were talking about with that statistic about 12 months later after a correction like this.
Yeah. So, I mean, if you look back again, historically, last 75, 76 years of data, once the market hits its bottom, within 12 months, last 75 years, every time we've gone into a bear market after it's hit its bottom, we've had double-digit returns. I mean, and the average return has been over 40%. I mean, that is significant. And so to me, I think if you look at the accumulator, because you kind of let into their Hans about somebody in distribution, the accumulator, this is a great time to buy. This is a great time to buy. If you're in retirement and you got excess cash, might also be a good time to buy. But for the person who's either nearing retirement, in retirement, understanding how sequence of return can really hurt us is important. And I think what Brian was talking to earlier, if we look at somebody who retired maybe right in 2007 timeframe, and let's say you were in all equities, and as the market is crashing, you're continuing to just, if I was drawing a line on a spreadsheet, which many people do when they do their retirement plan, it doesn't factor in volatility. It factors in average return. Getting 9% out of the S&P 500 is very different than getting minus 20 and then plus 30, over a couple of years to get to that average 9%. And so what does that mean? That means when the market's going down and I'm having to sell stocks at a loss, I am now negatively compounding my portfolio downwards. And if we look back on some of the deeper recessions that we've had and some of the deeper, bear markets that we've had, that is where somebody can really start to implode their lifetime retirement income. And so we need some sort of buffer in there that's going to allow for us to buy those stocks time to breathe, buy them time to come back. And so, like if I look back at history too, and again, this isn't that bear market guide I sent you guys that you'll be able to send to your listeners as well. If we look back on the very worst bear market we had in terms of number of days where we went from our top to our bottom was March 24th of 2000 to October 9th of 2002, .com crash. It took 929 days from us to get to our top to our bottom. And then we went basically straight up to 2008. And then we went from October 9th of 2007 down to March 9th of 2009, 517 days of the market going down. And again, that's not for the faint of heart. And we got a whole generation of people right now that are working on buttoning up their retirement plans that back then in 2000, they were just getting their savings started. Back then in 2008, 2009, they were maybe mid-career. And so now they might have $1 or $2 million and it can be a little sheltered mentally of like how hard that's going to be to watch those investments go down for 2 to 3 years. However, if you can survive that time frame without selling stocks at a loss, so when they start to tumble, you don't sell any of that. We got to dip from somewhere else. And then we can maintain that exposure to stocks even while they're down and just let them recover and let them rise back up. We can really turn the tide in terms of how much retirement income we're able to take out of the portfolio. So if I can maintain a higher exposure to stocks or equities in retirement, I'm going to generate better lifetime returns. However, because of the volatility, because of times like this, years like this, I need to have some dry powder on the sidelines. Now that dry powder isn't to buy, NVIDIA stock at a low. That dry powder is to pay bills and stop taking distributions out of my stocks and let them recover. And so the purpose of the dry powder is different, but it's still super important to have it. So what we typically recommend is, if you're younger in your career, When you're building up one of these policies, you always want to have 12 to 18 months of dry powder out there, right? And so in a time like this, maybe I pull 12 months out, put it in the market, and I shrink my dry powder down to 6 months of cash, and then I let it build up. But in retirement, we want to shift that to 3 to 5 years. And if I have 3 to 5 years of cash sitting out there, it's got to come from somewhere, right? It's either, let's say I was uninsurable. Well, I got to have it in cash, money market, or some sort of fixed bonds, ideally, where I know, and that's some of the reviews we've been doing here over the past week or two, is looking at people's plan and saying like, hey, I know the market's down a good bit right now, but if we look at how many months of cash flow you have, Mr. or Mrs. Client, you have 42 months of cash, money market, and bonds on the sideline. How do you feel about that? Do you feel like what's going on in the market right now is going to be something you're super concerned about 42 months from now? Probably not. What were you concerned about 42 months ago? Probably the pandemic, roughly. Where are the accounts at now from then? They're doing pretty good. And we thought, everybody thought the world was going to end back then from an economic standpoint. So to me, I think, having some of that dry powder, and it gives us space to breathe emotionally and like behaviorally do the right things. Then it also, like, mathematically really statistically increases our chances of not only success, but our likelihood of being able to take more out of our accounts throughout a retirement time frame. So again, you look back at, 2000 to 2002, we lost 49% of the market. 2007, 2009, we lost 56% of the market. In 2020, we lost 33%. 2022, we lost 25%. We've had a lot of downturns. And if you want to be a stock market investor, you got to be willing to take those times. But you got to have a plan to, if you're retired, get through those times. And if you're accumulating, really capitalize on those times. And so I think, you got to find a way to have some of that dry powder on the sidelines. And that's where I think these policies can really be beneficial to people. Because again, we're going to buy cars. We're going to, remodel the kitchen. We're going to, do all sorts of financing out there for stuff typically. And if I can self-finance or avoid taking a high interest home equity loan, we're going to keep all that on our side of the balance sheet, which is going to compound on our back.
Brian's kind of case study that he did, and you can find this on a previous podcast where we walked through it in more detail, but basically starting in, I think it was 2000, and did a 12-year snapshot. And if you were able to pull out the 3 worst years and just get by on another asset, i.e. in this case, cash value, or as what we call permission to spend, the book by Tom Wall that says that having the life insurance in place and having the cash value available to you to cover up these down years and not have to take distributions, the difference between what you had when you had to pull from the down market over that 12-year period, including 2008, versus if you could just swap that out, pay with your cash value, support your lifestyle that way, the difference was astronomical. I can't remember the numbers exactly, but it was a really powerful validation of the permission to spend concept, which you can find that book on our reading list on the website. It's a really good. Tom Wall is a PhD. He has a PhD in retirement planning, and so he just runs through all kinds of scenarios, and having access to cash value is invaluable as far as making sure that, one, this concept we're talking about, using the dry powder, using this for your living expenses so you don't take these down distributions. And the other thing being, you have this nest egg. If you're piling all of the jobs on this nest egg, which is supporting you and your spouse for an undefined amount of time, and also leaving something to your family, you have to really be very intentional in your drawdown strategy. If you know that your entire asset value is going to be replaced upon death and your children will inherit that full amount, then you now have permission to spend down these assets without the stress of what am I going to leave behind. And so it's easing the burden and kind of adding more planks that the weight rests on, so to speak. So that's a good book I would recommend checking out for kind of a further deep dive into this discussion.
Yeah, it's a good one for sure. I mean, anybody over 50 years old should read that book because that's when they really need to start thinking about, getting that retirement income plan set up and making sure that they're getting the asset allocation that they're going to need to facilitate that kind of plan in retirement. Yeah.
And just, I guess as we wrap up here, well, last week, I believe for the first time in a long time, and I don't know how long it's been, but stocks, bonds, and the US dollar all went down together. And that's not supposed to happen. Those are supposed to be counterweights to each other, like stocks and bonds. And so when we're seeing such extreme volatility right now, some of the accepted rules of the game and how we think about this. If stocks and bonds are dropping at the same time, we need to rethink, everything we've assumed. And so the idea, like if you're in that kind of 60-40 portfolio in retirement or something, you don't have that safety net that you were planning on. And so I think right now is a great time to keep your head on a swivel and be prepared for all eventualities and all circumstances, because this is beyond, to me, this current swing, this current cycle is beyond simply market volatility. That is certainly an extreme output of this, but I think that there's a lot going on the macroeconomic side of things that is very different than previous iterations, because before it was like, all right, here's a policy decision regarding COVID. Here is, the underlying rules of the game remain the same, but we have, a subprime mortgage crisis. The underlying rules remain the same, but we have the pandemic, right? In this situation, what is driving this drop is not some external factor that is making its way into the accepted macroeconomic rules. The reason for this drop very specifically is the changing of these macroeconomic rules. What they're trying to do, if you listen to what Scott Bessent and Howard Lutnick have said, as far as what they're trying to do with this, the big picture strategy, Howard Lutnick straight up said it. The American dream is not being able to just buy cheap things from China. Like, we have been neglecting the middle class, and the markets and the wealthy in this country have been soaring for decades now. They're explicit. They're okay with the stock market dropping as this gets sorted out.
Right.
The fact that we've had such massive swings just on the announcement of tariffs and then the announcement of pausing them. So we got a 90-day pause in tariffs. There's so much going on that the market just can't price in. I think we can expect this kind of just whiplash to continue to happen as things get shaken up. But they are okay with the market going down for a while. I don't think it's going to be long term. I think the way they're talking about it is, this is going to hurt, but we need it. And then it's going to be much, much better long term. We're kind of getting a lot of the uncertainties out of the system, but they're not going to do the same thing they did before, which is the market takes a huge crash. We paper it over. The Fed comes in, backstops everything. We spray money everywhere, and we artificially get this thing back on life support and pumping. It seems like they're really going to let the fever break. And if they do, then we might have that situation where we do have 12 months of this. If you just retired, you need to be ready for that. And again, like even what feels like a massive correction over the last 2 weeks just brought us back to where we were 12 months ago. And so I want everyone listening to be ready with like their growth strategy long-term, but also with short-term volatility protection, and just keep your head on a swivel, because this is really fascinating from a macroeconomic nerd side of things.
Yeah. I mean, and to your point, you look back at the COVID time, you look back at the financial recession, and there was a lot of Federal Reserve bailing us out, pumping a lot of money in the market. It would be counter the logic of all this trade policy and all the what's coming out of the White House. It would be counter to that logic to say, well, we'll count on the Fed to just, push funds out there to help get this thing, like you said, off of life support. So again, if you look at a lot of the economic data, there's some pockets of things underperforming right now, but it still is a lot of good news story. But again, a lot of that can change very, very quickly. So I think it's more so, regardless of what's going on short term, what is our plan and what are the right behaviors we need to engage in to develop that plan long term. It gets mission critical to start thinking about being more sensitive to these things. I'd say about 5 years out from retirement. Absolutely. For some of your airline folks, if they're 55, 60, yes, you need to be getting things dialed in. That is an absolute fact. But prior to that, man, I mean, if the market stays flat this year or is down a little bit this year, believe me, if anybody wants to see it go up and be able to talk to clients about great returns, it's me. But also for, all of us young guys, I mean, man, if we can buy it all at the same price this year, and then it does double next year, we're that much better off long-term by the prices being a little bit low. And so some of it is just having that good disciplined mindset too, around like, hey, when eggs are expensive, I'm complaining, but when the market's expensive, I love it. It doesn't make any sense because I'm still buying both. And so, if we can, have that mindset and at least reframe some of the adversity here as, hey, I get a good opportunity to buy. then that's a good mindset and it keeps you in the game. So I think that's important. But to your point, you look back at 2022, right? The 60-40 portfolio, 60% stocks, 40% bonds just got hammered. And that's where I think a lot of folks who are in bond funds are taking way more risk than they realize. And so to me, like, growth money is where the risk is. We don't know what it's going to do short term, but we know what the long-term averages are, and we want to seek those good long-term averages to compound on our behalf. But if we're not in that growth bucket and we're looking for safe money, let's seek out guarantees. Let's seek out cash, money markets. I don't mind some bond ladders out there for people that are retired where we know what the coupon rate is and it's a highly reputable government entity or corporate company and it's a highly rated bond. Yeah, go get some of those to fund your fixed guaranteed money. Go get one of these policies. There's no ifs, ands, or whats. It's guaranteed. As long as the insurance company is in business like it has been the last 162 years, this is insurance guaranteed. And so to me, let's get guaranteed things and do guaranteed things, and let's let growth things do what growth things do, and then follow that process. So I think if we can just engage in that kind of mindset and do the right behaviors, it's going to serve us better long-term than trying to play any of these short-term games of time and tops, time and bottoms, feeling bad that I missed the bottom and all that stuff. I mean, it's not a good mindset, and it's going to lead to less than desirable outcomes long-term.
And if anyone's wondering why Brian's just disappeared, he's having a tech issue and moved to a new house. He's back in his old house where he still has his recording stuff. So he's still here, but he's muted. But I want to talk about bonds real quick, because to me, there's two ways that you can approach it. If you consider bonds, and I would like to know how you frame it when you're talking, because you can think about bonds two ways. If you just have say a bond ETF, and that is your bonds, strategy, well, then bonds go down, bonds go up based on the rates, right? You're not looking at it as a guaranteed return coupon product. You're looking at it as an investment product. In my mind, a bond ETF is still a stock. Theoretically, you're getting you're not getting any guarantees there. You're taking something that is itself a bond with a coupon with guaranteed returns. Like, just owning a bond yourself, I think is valuable, because I don't really care what the market's doing. If I'm looking at all of my cash flow and I know that this bond is going to pay me, say, if I average it out, so $500 a month or something, like, I can count on that because I know this bond is going to pay me. There's value in a bond portfolio of having that guarantee. Now, I do that with cash value instead. I don't worry about bonds. But if I'm not doing IBC, if I don't have whole life, if you have a portfolio of bonds that you can take, if you know the return, this bond will return X amount, this is the coupon rate, that you can plan around. And that is a volatility buffer, because if stocks are going down, it doesn't matter, because this is still going to generate, this total bond portfolio where I own the bonds is going to generate, say, $3,000 a month of income. Different from that, and the way that I see it more often framed when people talk about bonds, is a bond ETF, where we just want to know that stocks go down, bonds go up generally, the rates on bonds, and therefore the ETF goes up. So I think there's two different ways that you can integrate bonds there. One of them, to me, is still subjecting it to the fluctuations of the market, which now that we're seeing bonds can go up and stocks can go up and down together, kind of breaking that counterweight function that they've always been there. How do you look at, the actual, like, we want the return from a bond. We want to own the bond and get the income from it. And we don't care what bond rates are doing, because we're not trading this bond for the sake of, trading on volatility here. We're just trying to get the coupon, versus just a bond ETF or exposure to the rates of bonds.
In terms of like the bond ETF, I would say it's not necessarily like the same as stocks, but we're getting exposure to an asset class. And so, I'm not a huge advocate of that. There's a little bit of that going on now that, bonds fell to basically a 25-year low after 2022. We had zero in the portfolio before that. And then after that gigantic crash in 2022, and when rates skyrocketed, again, like anything else, it's like, okay, they're at a 25-year low. That might be a time to put some of them in the portfolio as a little hedge against volatility. And that served us well. I mean, especially right now, when you look at, some of the rebalancing going on, and it's like, all right, let's ditch those and buy some of these technology stocks that are down 35%. So there's ways that you can do that. in terms of looking at it like an asset class. Now, I will say that I think building the traditional 60-40 portfolio is something that was probably done by some either people or pundits or other advisors or something, like looking in the rearview mirror. But when you look in the rearview mirror, you can't factor in things like, hey, that 60-40 portfolio performed really well when interest rates were between 5 and 12%, for 2 decades. Where now we're in a 2-decade time frame where interest rates are between 1 and 3%. So, it's just two totally different environments. Now, what I will say in terms of how we do use them and why we don't like them as that asset class that's going to really help us in the growth bucket, we really like them in that income planning phase. And it's a little bit of what you're talking about, not so much, to generate monthly income for us, but the way we'll do it is, we'll buy, there's basically, you can buy like a custom built out bond ladder. So let's say, Hans, you were retiring this year, you were coming to see me. We'd say, okay, well, hey, you got cash sitting over here. You're getting some payout from your company or sick pay payout or whatever the case is. And then let's take some of that cash and we're going to build you an income ladder. So we're going to go out. It's it's April of 2025 right now. You got some cash to get you through 2025. But we want to build out something that's going to, by December of 2025, we got all your cash, that all these bonds come due in December, where now we have this pile of cash that's your money for 2026. And again, what the coupon rate's going to be. And so we can kind of reverse engineer and run the reverse compound interest to say, all right, if you need $100,000 next year, then we're going to fund it with $85,000 right now. Then we're going to run it for your 2027 income, 28 income, 29 income. And again, what did I say earlier? 3 to 5 years, right? So for right now, let's say we're going to run that out to 2030, just to give you that full 4.5 years of income. Well, what we do from there is you're living off of that cash. Those bonds come due and you live off of that cash the next year. And then as the market is up or down, if the market's up, we'll skim some of that profit. Again, this is for our retired folks, and we'll go fund that next leg of that ladder. So 2031 is getting funded. If the market's down, like in 2022, we rebalance that account, but we're not selling stocks at a loss. You're just going to live off of another rung of that income ladder. And if the market was down in 23, you're going to live off of another rung of that income ladder before we start to sell off. And so that's how we'll kind of skim profit when it's higher than average in that growth bucket. But then if it's down, we just keep living off of those income rungs of that ladder and give those stocks time to recover. And then once they're recovered is when we'll come over and we'll go build that bond ladder. And again, we like to use a very specific company that are experts in going and, finding, hey, here's 20 bonds that are going to all mature in 2026. And when that all matures, that's your income for 2027. And so that way it's right there on a silver platter for clients. They can see it in their account statements and it's very clear on where their income is coming from. And even that, again, is extremely powerful in getting somebody to like behaviorally stick with a plan versus like, hey, I know there's like this one bond ETF, that's your safe money. And I know in 2022 it was down 20%, but that's the safe bucket. No. I want to know, like, this is specifically, this holding is your money for 2026. So it's coming, tune out the noise, stick with the plan. So hopefully does that answer your question a little bit in terms of how we look at it and build it out?
Yeah, it does. And I like that. I think that's a much more sound approach. And when of course, we always, protect, save, grow. Me and Brian are on the protect and save side. You're on the grow side. You need all three components. In my mind, when I'm thinking about my plan, what the conventional model would say is my bond allocation. To me, I move that from my growth asset or my growth allocation altogether. To me, that's in my cash value that is locked away, growing guaranteed. I don't have any interest in bonds personally because I achieve the same function via my cash value pool, my total banking system for my family. But for people that are, we have people that we've talked about this, are like, I'm just not interested in doing dividend banking. I don't want whole life, whatever. And so that's good that, hey, if you're listening and you're not interested in what Brian and I do, but you still want to have that safety asset, I think that's a great alternative strategy for putting in that safety and having if you have some guarantees in your strategy for times like this, I really like that approach to it. If you're not doing IBC, personally, I'm going to stick with my cash value, but that's a much more sound approach to me than having exposure to just the rate of the bond index.
Again, it's, to your point, there's going to be people that are uninsurable, or insurance is just too expensive, or it's prohibitive, or, maybe they're coming in and they're retired and they need the income plan now. And they don't have time to build up that cash value. And, those are the folks that sometimes you say, man, I wish you would have met with Hans and Brian 20 years ago, but we're here today and we'll build it out with what you got. But yeah, I mean, with time on your side, it absolutely makes all sorts of sense. And it gives you the flexibility of the asset too, with, everything you guys got going on inside of the policy, and the flexibility there too it's super powerful for sure.
Yeah. And we have a 68, 69-year-old client that put a policy in force. You're likely not too old. If you are uninsurable, you have an insurable interest in family members. So maybe you can't get insurance yourself, but you can get it on a spouse or children. It's worth exploring if you can get coverage. And, even if you think that it's not going to work for you to get a policy, let's have the conversation and see, at least find out, verify that. But we can structure a policy that generates significant early cash value for a 68-year-old. That's going to be a different policy structure discussion than we're having with a 30-year-old client. But, it can be done. So give it a shot. But if you are just not interested in this at all, I think that's a very solid alternative way to get some protection and safety into your overall asset allocation strategy.
Yep, for sure.
I'm back, but I think my speakers are causing a little bit of an echo for you guys because I haven't figured out that side of the audio. But good discussion, guys. I'm glad to have listened to most of it.
Yeah, Scott, you got anything else? We want to wrap it up here.
I guess what I would leave you with, I know we talk a lot about a lot of different topics. I know I do on my podcast as well. But to me, what I always like to come back to with myself, my family, my kids, my clients, I'm sure you guys from your military experience too, it's like, hey, control what you can control. We cannot control monetary policy. We can't control foreign trade policy. We can't control what the market does, how it reacts, etc. All we can do is really build a plan, have faith that that plan is going to work. And to me, I would leave us with like a couple key things of what we can do with the growth bucket while we're in these times of market volatility and off of market highs. So again, this isn't the guide that I sent you, but I'll just go through these handful of things real quick. First and foremost, revisit the plan, right? Look at your protect, save, and grow. Am I funding all these things the right way? Is there anything I need to shore up? The second thing, Roth conversions. If you were going to do a Roth conversion this year anyways, maybe you have an old 401k or something you're going to convert to Roth, this is a great time to do it. The lower the account balance is, the less your tax bill is going to be when you do that Roth conversion. So it's a great time for that. Another strategy, tax loss harvesting. This is where we can maybe, sell one asset at a loss and offset a capital gain that we have and still put our money in some other asset class that's getting similar exposure to the stock market. And in doing that, we can mitigate a lot of capital gains tax. The next one here, rebalance your portfolio. This is a great time if you look at the different asset classes. If you sold some of your bonds and some of your international and went and bought technology or an S&P 500, that was a good time to do it over the last couple of weeks. So it's a good time to rebalance. And then the last couple here, the 401k side, if you can increase your contributions and figure that out in your budget, try to max your 401k early in the year. Odds are 80% chance again that the market's going to be higher at the end of the year than it is right now. That's what it is every year on January 1st. You got an 80% chance. So the sooner we can max it out, if we can get our IRA contributions in early instead of late, those are all things that we can do to take advantage of the market while it's down. Because candidly, we might not see these equity prices again. It's a good time to get some of these things in our plan done.
I particularly like the tax loss harvesting idea, where if you think about the value of a dollar, depending on where it is, it has a different actual value. It's not just every dollar is equal. A dollar of cash value is different than a dollar in a bond, is different than a dollar in a money market account, is different than a dollar you pay to the government, to the IRS. And so those tax dollars that you can bring back into your economy are very valuable. And so if you have this dependopotamus attached to you at all times, anything you earn, they're going to be reaching out with their hand, and that is the IRS, that is the government, and they want to take a third of what you make. Typically, depending on where you live, out in California here, maybe 40% is no matter what you do, no matter how well you do, they're right there with their hands ready to go. I need more. So anything you can do to beat them back is valuable. And so it might be worth in the same way that you might sell a non-performing asset right now in order to shed some of that tax burden. If you can implement a solid tax strategy, that alone right there, making a 10% gain is great, but shaving off a 30% loss is even better. And so it's worth it. If you want, we have our tax strategists that we work with. If you want to
Tax Sherpa, let's give him a plug. Go to check out Tax Sherpa. He's been awesome. You can listen to our old interview with him. We talked more about some of the things that were being said politically and economically at the time, but yeah, he's been phenomenal for us.
Yeah, email us if you want an intro, just to see what he can do for you, what his team can do, things that they can implement. If you have a taxable entity in particular, if you're W-2 only, you should strive to change that this year. Get something that you can do to earn additional income and have a tax entity around that, because that's where all the value is. But it's worth hitting him up. If our listeners want to get in touch with Scott, we'll put his contact information again in the episode review that we send out each week. We'll put it in the show notes. And then if any of Scott's listeners want to explore infinite banking and see if it's something that they want to incorporate in their strategy, just talk to Scott and he can get you a call set up with us so that we can see what might make sense for you.
Love it, man. Thanks for the invite, guys.
I'm good. Yeah, good chatting with you guys. Please like, subscribe, check us out, go to our website. Same with Scott's podcast. If you want to give a little plug for your own, feel free.
Yeah, Wealthy Pilots Podcast. You can find us on retireairlines.com. That's my website. All the info is in there for any of the folks in the airline industry interested. We got a free toolkit we'll send you in the mail too, so feel free to head to the website and we'll get you plugged in. But yeah, appreciate the invite here, guys, and we'll look to share this info with our group as well. So,
all right, y'all. See you next time.
Sorry I didn't have much contribution, but I'm glad to be back on. Thanks for carrying the load. See you guys.
Cheers.